Welcome to The Real Money Show, the number 18778 Silver, the website guildhallwealth.com. My name is Jeremy Wiseman, and I am grateful to be joined by Jerry Correia. We are going to talk about a few things this week, specifically about the news about stagflation, something that we have discussed at length on this show. And Jerry, you in particular have been talking about this and expecting this for quite some time. And our listeners know that you have been on top of this. It has finally come to fruition. We're going to talk about that. Real versus nominal returns. Yes, it's great to see a stock portfolio rising, but is it keeping up with what you need it to do? And then as well, given that we're now in September, let's talk about timing in the market and what that looks like. First, so far this year, Jerry, in US dollars, not sure if you are aware, but gold is up 13% so far this year, or year over year, I should say, which is pretty good when we're talking about inflation. Again, up 419% over the last 20 years, and it's been up 61% over the last 5 years. So gold is definitely doing its job against, in terms of maintaining purchasing power. And I always want to reiterate that gold has only had 2 down years, one in 2021, the year of transitory inflation. Gold was down 4%. Then you'd all have to go all the way back to 2013. I don't even know if you can remember what you were doing back in 2013, but you'd have to go back that far to see another down year in the gold market. And that was on the back of Bernanke about to save the world. He was on Time magazine that interest rates would one day get back to normal. And yet the Fed didn't do anything about that. They just kept talking and saying, well, we don't think the economy's strong enough. And now that they've created trillions, they're saying it's so resilient. And of course, it's all your fault. So I just wanted to put that out there. I think that on a whole, gold has done very well this year. Silver's done very well this year. We're kind of on par for the year. We're kind of haven't really made those big moves. So when we talk about timing a little later on in the show, we can project what we think we might be able to see in the back half of the year here. So let's start with stagflation.
Yeah, the stagflation, it's as you know and the listeners know, this is a topic. It's a very unique situation. It's when we have a combination between stagnation and high inflation, something that we saw in the 70s. And if you do a quick search on this topic, you will notice that, first of all, it happened during the 70s. The last time we saw stagflation was 70s. And things are starting to rhyme with the 70s. Can it happen again? It very well could. It does look like. It was a slew of data that came out this week. A very telling reminder of this soft landing narrative may still have some sticky inflation resistance. The Federal Reserve's preferred inflation metric, first of all, came out this week. It rose to 4.2%. They also focus on services, excluding shelter, also rising and staying high at 4.6%. Again, these are the Fed's rates. If we factor in how inflation was calculated in the 80s, inflation would be much, much higher than that number. And it definitely caps off like a raft of economic metrics this week that really point that stagflation risks are dead ahead. High inflation and low growth. We had durable goods coming out, dropping the most since 2017, Jeremy. Also, GDP growth, it was quietly revised lower last week, of course, amongst other things and other metrics that the Fed and the government love to revise lower. And the labor market is also worsening quickly too. So these are all comparisons to the 70s. This is why many analysts, including Crescat Capital, Octavio Costa, just spoke about these differences. And he mentioned a notable contrast to the 70s was today's inequality problem. We're seeing this contrast of, we talked about the top 1% and the lower. There's a convergence of the current wealth gap disparity, something that we saw back then. And we're seeing elevated costs. How many people are squeezed? Credit card debt is just through the roof in the States. The cost of living is set to concentrate the growing wage pressure predominantly among the lower classes. What does the government do to confront these challenges? Just printing. They're extending fiscal stimulus measured at addressing social welfare problems. It never works. And all it's doing is contributing to the exacerbation of the inflationary problem. So we had a comment from Bloomberg macro strategist Simon White. While everyone's talking recession, no one's drawing the distinction between the types of recessions. And Bloomberg macro strategist Simon White yesterday discussed the stagflationary setup. And the setup is huge. Through the 70s, Jeremy, a decade marked with high inflation and stagnant growth. Year over year, we're seeing stocks this week and last week had earnings seasons. And year over year, many of the stocks in the companies have seen their profits slashed almost in half. So this is stagnant growth and deep recession talks. Commodities were the only major asset class to deliver significantly positive real return. And the chart shows, according to Bloomberg and the strategist, that we had real returns in commodities up over 400% in that decade. And this is the reason why I love this topic of stagflation, because in an era where you have a decade-long losing stock market, you had a decades-long worth of gains in precious metals. Why? Because metals are tightly correlated with the commodity sector, because they're not just commodities as well, they're also monetary metals as well. So you have this unique combination of positioning against the threats of inflation, but you're also positioning now tactically. Higher allocations in precious metals will cause your portfolio to grow. And this is the point, isn't it, Jeremy?
Yeah, I believe so. The number 18778 silver, the website guildhallwealth.com, because if we're looking at stagflation, meaning negative growth, and they did just come out this week saying that in Canada that the economy in the second quarter contracted more than expected. It was unexpected, right? Yeah, more of those experts.
We didn't know.
And then you also have higher inflation. So low growth, higher inflation, and that's obviously going to lead to the third part of it, which is higher unemployment. Now, the other problem with the unexpected growth is that it's going to be bad for the dollar. And if the dollar goes down against the US dollar, then that in effect creates more inflation. So you're going to now amplify these issues. More weaker economic growth and more inflation, which is going to lead to companies having to cut back, as you're saying. No wonder companies are slashing budgets and not seeing their productivity. So this is the pure definition of stagflation. And to your point, what happens is people are going to run for safety, and they want real money. They want a place where the value is going to be stored. And what it also means is that we're seeing the end of free money, the end of cheap money, money being debt, right? That's been borrowed into existence. And so reality is setting in. Reality is setting in. And while in 2018-19, people were wonderfully investing in their NFTs, right?
Yeah.
I don't know if do you remember those? Which stands for?
Non-fungible tokens.
Non-fungible tokens, or digital art. Those days are ending. It's give me the real money.
That's right.
Right. Hence the Real Money Show.
Give me real returns, not nominal returns.
And look you can look back at the 70s, early 80s, and you had gold throughout that decade go from $35 an ounce to a high of $850, and then when it pulled back, it landed at $350. That's huge gains. Silver went from under $4 an ounce to as high as $50 an ounce. And in today's world, there's no silver like you had in 1980. China and India were not involved in the market. I think the population of the planet was something like 3 billion people. So, you're up to almost 8 billion people. And you're just being gaslit left, right, and center about everything. And so it's hard to tell what's real. And so this is another aspect of gold and silver where you can look to reality and say, that is real money. That it has been money for thousands of years. It is on the table of elements. And when the debts are now really starting to matter, you need protection. And so that's where gold and silver come into play. And as more people move into these markets, which are relatively small, you could have a billionaire, you could have several billionaires buy the entire silver market. It doesn't take a lot. You're looking at what, 200 million ounces or 2 billion ounces at $24 an ounce, right? That's less than $500 billion. There's a lot more money being made in the world.
That's right.
Right. So those are not huge numbers. So imagine what happens when everybody gets together, the masses, right? And they don't buy gold. They buy the people's gold. Imagine what happens to the price of silver when people start to really panic and get involved. It goes wild. And
That's
so
right.
you're looking at a finite commodity in a world where people want safety and everyone pouring into that market at a single time. That's where, 10% of the people make 90% of the money, and it's the people who get in early. It's the people who get in before that major move happens. And what you're saying, Jerry, if I put it all together, when did stagflation start to hit in the US in the 70s? It was towards the end of the 70s. And so as we move through this and past it, it's the time to acquire, because we're going to see the big moves in this market still to come.
Exactly.
The number 18778 silver, the website guildhallwealth.com. More to come on the Real Money Show on 640 Toronto. Welcome back to the Real Money Show. The number 18778 silver, the website guildhallwealth.com. These are definitely trying economic times, and they are really pushing the middle classes with rising interest rates, lowering economic output, and there's definitely feeling a crunch. And where do you turn to when, in our opinion, you look at the stock market and how is it supposed to be performing when all of these companies are going to be also feeling that pinch for margins? Margins are going to get smaller and smaller as all of their costs go up, and this is not a good sign. So for us, having physical precious metals, real money in the portfolio, it's not a panacea. It's not the end all be all. It's all about having a portion in. We're not advisors. Gold and silver are not equities. They're not investments. It's simply real money. It's been money for thousands of years. It is stored wealth. It is stored value. And anyone in the last couple of years can see with inflation, the real world purchasing power of their dollar has been declining rapidly. What once cost $100 now costs $200, but you're not doubling your income. So how do you protect against that? Now, gold and silver are not action reaction necessarily in terms of inflation hits 15%, so gold goes up automatically 15%. No, this is a global phenomenon here. Globally, all of these countries around the world have debased their currency. This actually starts to lead to the BRICS, because they're trying to figure out a way to combat that.
To avoid it.
They want to build value. They want to be Mexico first, Russia first, China first, Saudi Arabia first, and a whole slew of other countries that want to be their country first and build value, but base it off of something where they can guarantee that value. I was talking to someone the other day, Jerry, about the fact that there have been times, especially in the States, where inflation didn't really rise for 50 years. And a bottle of Coke cost the same for 50 years. Imagine your cup of coffee was 25 cents for the next 30 years. Imagine that. Imagine the economic decisions you could make.
Right.
If your purchasing power were stable for 30, 40, 50 years. Now, what they've been doing has been stealing the wealth by stealth. People will ask us, well, what if they confiscate your gold? Listen, they steal 30, 40% of our income. We pay 30, 40% taxes. And then we go out with every dollar after that, and we have to spend more on taxes.
And we can anticipate more taxes.
And then rather than raising taxes, they deficit spend us into a 15% secret tax called inflation.
Double whammies.
Those are debt slave numbers,
right,
for you, for me, for everybody. And how do you protect against that? Well, if you don't like the agenda, you can unsubscribe. That's what I love about precious metals. You unsubscribe. You say, you know what? I'm going to put my money, my cash that's losing value by the day, into physical gold. Physical gold is not losing money by the day. It's up 400% in the last 20 years. And we're not cherry picking that. Okay, there's been 2 down years in the last 15. That's not cherry picking. to say that it's gone up that long. So the importance here is to have some physical. And at Guildhall, I know this has been a long talk, okay?
An important
but
one, Jeremy.
At Guildhall, we deal only in physical. You can buy it direct. You can put it into your RSP, where, and I really, this is the best place for it. Actual physical precious metals in a registered account, held in a vault outside the banking system that can't be eroded, can't be corroded, can't go to zero, right? Can't go bankrupt, can't default. It's
Most
physical.
importantly for me, sitting in a vault, you can't hack it. It can't be deleted. Those numbers can't be deleted nor bailed in. And these are dangers that by converting out of paper fiat currencies that are just being eroded, erosion is not even it. Erosion sounds like it's very slow. This is a rapid deterioration. Look how quickly our lives have been turned upside down over the past 6 months. It's September now, September 1st, and we're going to get into the timing. But this is the time. If you have a portfolio right now sitting in something that is denominated in cash, this worthless fiat currency, now is the time to convert and undigitize your wealth and take the power of your wealth in your own hands. Because if you cannot own it, if you can't hold it, you do not own it.
Yeah, let's talk about an example of what it would look like, because we've talked in the past, about buying a home with silver. And when I started working here, I think you needed, I want to say something like 5,000 ounces of silver to buy a home, which seemed like a lot. I can't quite remember, but now it's a ridiculous amount, right? If you look at silver in Canadian dollars, I mean, what's silver in Canadian? Which we should probably talk about that. Why do we always talk about it in US versus Canadian? It's because it's the global currency. So we have to calculate in US dollars first, right, and then convert into Canadian. But if we say that an average home in Toronto is $1.5 million, maybe that and falling a little bit, and we say divide that by 30, let's just say $30 an ounce Canadian. It's 50,000 ounces of silver to buy a house, not 5,000.
That's what it was in 2003, according to this chart from Gold Silver, about 53,000 ounces to buy an average home in the States.
Was how much? It was 53,000?
53,000 ounces.
Right. And what is it today?
And
according to them in the States?
Today we're about 30 to 40,000 ounces. Well, then we look back to the end of stagflationary period, you needed 2,052 ounces, Jeremy. 2,000 ounces of silver bought yourself an average home.
Okay, so I was on point.
Totally
I said
on point.
5,000 ounces. If we double that number, to be conservative, you say 5,000 ounces of silver to buy a home. And 5,000 ounces of silver today is going to cost you somewhere in the range of
about 170.
About 170.
Yep.
Okay.
150 could be.
Those are good numbers. Now
Of
you can't live in your silver, but if you could put 130,000 aside and see where this market goes over the next few years, that would be something. I mean, if you had a portfolio of $1 million and you're simply hedging 20%, 15% into silver, you could see in the next few years that you could own a house with your hedge.
And what we're doing here is we're eliminating the debt, that slave debt that you want to eliminate, whether it be buying it outright, mortgage free, or paying off that expensive mortgage, or other expensive, interest bearing debts that you may have. This is unshackling yourself from the debt. You are eliminating debt out of your life. And this is what, this is why we focus on this stagflationary. Yes, the stagflationary period is a dangerous thing, especially if you're in financials and paper instruments valued in currencies. By number one, protecting and converting out of those currencies and into the metals, you're now not just surviving, you're positioned for that amazing thrive. And there's nothing better than that. This is why we do what we do, Jeremy.
So where could the nominal and value price of silver go over the next few years? Like, do you have a personal projection? I'm always
I did that projection
I always
today.
say let's get past $30, which I think we will get to in the next I don't know, next year. We'll definitely break 30 at some point in the near term. And at that point we'll be heading off into a new ball game, because we went from the prices of the metals, silver trading between 16 and 19 for several years, and then it kicked into the 20s, and we saw it as high as 31, and then we've been consolidating in the 20 range, between 22 and 27, which is a bigger range now, but we're much higher than we were. And then once we break 30, we're all of a sudden into a new range. But ultimately, where could we see it going? I mean, if you look at the gold to silver ratio and these type of things. And again, we're kind of hinting at this nominal versus actual, but I don't see a reason why it couldn't go over $100 an ounce.
These are the real returns that I crunched this morning with some clients that came in. I'm talking about gold during the 70s. Gold delivered stellar returns in the 70s during that era of stagflation. Gold went up anywhere from $35 an ounce to $681 per ounce. That's 838%. If we were to repeat that today at 1940 USD per ounce plus 838% real returns, we're talking about $16,257 US. At the end of 1980 of stagflationary cycle, we went down to a 20-to-1 ratio. That would put silver at $2,750 US. And today's price, if you were to buy 2,000 ounces of silver today, which would be 54,000 US dollars, call it, which is about 70,000 Canadian. And in a few years, maybe a decade long, your 2,000 ounces that you just paid $70,000 for decided to leap up to 2,750. You would have a portfolio worth $5.5 million USD. Is that the type of performance that we need? Are we just surviving here with silver? Yes, you are surviving with silver, but we also need returns. This is the Real Money show for a reason. We're here to provide you with real money, number one, gold and silver, physical precious metals, but you also need real returns.
I think it's one of these things that I know personally, because I started buying gold in 2006, that the longer you hold it, the better it works. Because the more you hold it in a world where they're debasing currencies, the better it gets over time. And what happens in this market as well, I've noticed with clients over the years, is that there's always an anxiety between when you buy in and when the market goes over the cost to acquire it. Right? There's a barrier to entry because it's an actual retail product. And once you break that barrier to entry and then move to that next level, look at silver. It goes from 17 into the 20s. You've breached that barrier to entry, and now you've overcome a trading range.
Right.
And so now, sometimes you're up 40%, sometimes you're up 30%, but you can weather the volatility because it's staying in the green. And that's what I notice in this market long term. Right. Now, yes, if you FOMO'd and you bought right at the top of the market in a very small timing period, and I'm guilty of that too. Look, we're in the precious metals business. When do you think people buy the most? Here's a tip of the day. Most people buy at the top, okay? That's when the masses all come in. And we've seen a lot of savvy buyers over the years, but trust me, the masses all come in at the top. So there's a small window where you may have bought at the top, and hey, cost average. That's if so that's something that you could definitely do. But I've noticed over the years that it's always worked. The longer you hold it, the better it becomes and the better it looks. So I could definitely see that the longer I'm holding silver, that we break that 30, we move into the 50s, people acclimatize to the 50s, people acclimatize to the 100s, and it could fast move into the thousands. It could happen. I mean, it happened with cryptocurrencies. And it could definitely happen with a real asset that's actually finite in the world, that's not infinitely divisible, Okay.
Right.
So that's something we can continue talking about in the next segment. But look, even if it doesn't go to $1,000 an ounce, if it went into the multiple hundreds, you're still looking in the millions of dollars based off of just over $100,000 acquisition. So lots to look forward to in this market. The number 18778 silver, the website guildhallwealth.com. We do have a promotion. For every 100 ounces of silver that you acquire, whether it's maples, 10-ounce bars, 100-ounce bars, doesn't matter. This is through the month of September. Whatever 100-ounce bars you're buying, you will get 1 ounce of silver for every 100 ounces that you buy.
It could be coins. You can get 10-ounce bars. You can get one 100-ounce bar, and you're getting one free Nadir 1-ounce bar. If you go with the 2,000 ounces of silver scenario, wink, wink, you're getting 20 of these bars. Beautiful gift. Pass them around. Give them to your friends, neighbors, kids, grandkids. It will last a lifetime. This is what it's all about.
Yeah, and that's depository, direct purchase, e-store, registered accounts. Have a ball. The number 18778 silver, the website guildhallwealth.com. More to come on The Real Money Show, 640 Toronto. Welcome back to The Real Money Show, the number 18778 silver, the website guildhallwealth.com. You know, we've been kind of talking about it at the periphery here, this idea of nominal versus real returns, because I know in my mind, Jerry, I always think about price is what you pay, but value is what you get. And in my mind, that means that for precious metals, yes, there's always going to be a price that you have to get, but down the road, you start to think, well, how many ounces do I have and what does it buy me? That's value. Right. We talk about that with the housing, with buying real estate. You could look at it in the same way. If I have 1,000 ounces, if I have 2,000 ounces of silver, maybe I have 5,000 ounces of silver. Great. How many ounces do I have and what can it buy me now? Right? Right now, it absolutely will not buy you a home. That means that either real estate is way overvalued or silver is way undervalued or it's somewhere in between. And it's a beautiful thing with precious metals that you can understand the value of the metals based on what it can buy you. And you create these ratios, gold to Dow ratio, debt to gold ratio. You know, in 1980 at the peak of the gold run, gold was $850 an ounce. The Dow Jones was 850 points. That's a 1-to-1 ratio. And the debt in the U.S. was $1 trillion. That's an 850 to 1. Mm-hmm. These are the type of ratios that you can look at to start to understand value.
Right.
So I just wanted to put that out there before we start talking about real versus nominal here, Jerry.
Yeah, because too few people understand the different dynamics and the real returns as opposed to nominal returns. A 6% return is zero if inflation is 6%. Now, and this is very important because we are entering into an inflationary recession. You know, nominal returns of stocks will mask the true damage done to equity portfolios. Now, bonds are supposed to rise in nominal terms, but in real terms, they start selling off long before the recession begins. That's what we're seeing. Now, we can compare to other safe havens because we want to avoid that. Gold's biggest competitor, quote unquote, for safe haven play during times of stagflation would be bonds. However, those turbulent times are in an inflationary period. They look very, very poor during stagflation. This is from the strategist from Bloomberg. He wrote, nonetheless, money illusion once again makes returns look better than they really are. In real terms, bonds typically sell off before the recession begins, the inflationary recession begins, and continue to sell off after it. It takes several years before an investor recovers their real losses, even though nominally they may have made the money.
I have a perfect example of that. After 2008, it took 5 years for people to get back to what they called break even. And I would talk to advisors, people working in the industry, and they said, yeah, it took 5 years. We got back to square one. And I'm thinking, you're not at square one. You've missed 5 years of inflation. 5 years of inflation at 5%. You're actually still 25% short, my friend.
Yeah.
That's a perfect example of nominal versus real. They're not thinking about inflation. Now, everybody is thinking about it. They know it. They're starting to understand it. Something that our listeners have been well versed in for years. We were the first to bring you shrinkflation. We were the first to warn you about stagflation. We were the first to talk about the coming inflation that we were going to see. And whether or not you believed us at the time, I hope you believe us now. And we're also talking about the fact that gold and silver have done a great job up until now, and they've got a lot further to go.
Oh, 100%, Jeremy. You hit the nail right on the head. If you look at all the major currencies over the past, going back to from 2007, they're all heading down versus gold. Gold actually, has been that defender against currency devaluation, and it's only going to continue. It's going to continue to get worse in the currencies because the fiscal spending right now, Jeremy, it's continuing to ravage the government. The U.S. government debt is projected to surge by $5 billion daily through 2033. The government's debt, it's off the charts. You can't fathom these numbers anymore. You can't even project them. They're off the charts. And if we consider all of the other things that are on the balance sheets besides the debt, including derivatives, this derivatives market, Jeremy, it's going to pop. And when it does, that money is going to all surge into the finite number of gold and silver. And we're going to eliminate the gold reserves and the silver reserves, more so the silver reserves.
Yeah, and on a different note, I think you kind of have to ask, what do you get for all of the debt that they've put you into? And now they're raising your cost of living to pay for all of that. Like, what did you get for it? What did you get? You got a bunch of attacks culturally. You got just attacked. You were told that you were racist. You were told that you need to trust experts. You were told to, just put up or shut up, or you were told that 15-minute cities are on their way, or you were told that you have to go green because somehow it was viable, even though it's completely not viable at this point.
Absolutely.
So, what did you get for all of this? And I think that people are starting to think for themselves. I think that that's very important. So don't believe us, just like they used to say on Reading Rainbow.
That's right.
Don't take my word for it. Do your own research. Go listen to some YouTube channels and see what they're saying about gold and silver. See what they're saying about 15-minute cities, or see what they're saying about how to improve your situation with physical precious metals and why they're holding precious metals. One of the things that you do get into with precious metals is you start to look at the world more geopolitically, and not everybody wants to be politically involved in that sense, but this is your money. It is politics. Mm-hmm. You are the politic. They are coming after you. They want your wealth, right? They didn't earn it. They absolutely didn't earn it. And the best thing that they can do is steal it and give it to someone else and take something for it in between. And I think gold and silver stands in the way of that. And I think that Greenspan, former chairman of the Federal Reserve, would say the exact same thing.
Yes.
So give us a call. We're happy to talk about it. You can tell we love talking about this stuff
all day long.
But do your own research. Check with those that you love and those that you trust. And come see us when you're ready. The number 1-877-8-SILVER, the website guildhallwealth.com. More to come. Still more to come on The Real Money Show on 640 Toronto. Welcome back to The Real Money Show. The number 1-877-8-SILVER, the website guildhallwealth.com. So we've talked about stagflation. We've talked about real return versus nominal return. One thing we haven't touched on, Jerry, I want to spend just a few minutes on is timing. There's often people looking to time the market. And what is that? Where would you say we are right now in terms of timing? For me as a stacker, I don't worry so much about timing, but some people are kind of looking to gauge when a good time to get involved in the market is. Is there a good time? Is there a season? Mm-hmm. Talk to us about some timing.
So definitely, if you're not involved in the market of precious metals, now is the time to get involved. But if you're like us, who already have skin in the game and we do have metals already in the portfolio, then timing would be something that you would want to employ. So firstly, you would want to look at the seasonality for gold and silver. We talked about this over the past few weeks. Historically, going back 40 years, summer months tend to be weak months, or gains in metals tend to be capped. We had a very buoyant and good, pretty good performing summer so far. But if you look at the performance of gold during the fall months, so September, October, November, December, these are very strong months for metals. So if you're into timing, definitely consider buying. You should have been buying during the summer, even early in the month of September, especially knowing that come September 20th, mark that in your calendars. It's Wednesdays. That's FOMC. The U.S. is looking to potentially hike for the final time. And in that case, we would be seeing a drop in the metals or drop in the US dollar and a very explosive move higher in the metals market. So look at timing the market with that. And historically, even the September stock market slump is a very good opportunity for gold. Historically, September has been a rough month for the stock market. So if you're looking at shuffling around, definitely this is the time for a very good opportunity to get into gold and silver, Jeremy.
Certainly last year, gold did very well. Silver did very well from October through January, through that time period. I know that in 2010, there was a massive run, 2010-11, and it really started at the end of August. We broke $20 in silver, and people were selling. They thought, oh, it's just going to drop back down to 17, and it just kept rolling. And by the time December 31st hit, we were at $29. So we'd gone from something like 16, a low of 16 that summer up to $29. And so big things can definitely happen in the fall. But if you haven't acquired, you have to. You got to get in at some point, and then you can kind of time the market. We talked before the show about Jim Rogers, and he's always on interviews, and you can tell he's got a very strong position in metals, and he says, yeah, I'm not really buying. But if something comes along where I get the real price that I would be very excited about, I'd certainly buy more. And I think that's kind of the stacker refrain as well, is you can always wait. Once you have product, you can always be patient. Let's talk about putting something together, Jerry. If someone wanted to really position themselves and get protected overall in these markets, they've never gotten involved in the market, but they say, let's put a package together. One of the things that they would put in that package would be a natural fancy colored diamond.
100%. The perfect way of rounding out a Guildhall hard asset portfolio is including a Guildhall natural fancy colored diamond. Offers the rarest exposure to the market. You're going to be owning something that is very, very unique. We will define rarity going forward in a diamond discovery session here at Guildhall. Using data driven or provided by the Fancy Color Research Foundation that has given us the data, given us the charts and the data that I need, indices that I need as a trader, as a trader. I need to see these figures and I need to understand how rare it is. So you will definitely need to have a natural fancy colored diamond in your portfolio as well. Yeah,
and we definitely love the pinks. We've seen pinks this year at auction starting to do very, very well,
strong,
just like they were doing back in 2015. And prior to that, even 2016 prior to that. And so what I thought we'd do is we put together a package. I started off with, we have a fancy pink pair. So it's a pink diamond. It's 0.27, just over a quarter cut. VS2. Now, that means very slight inclusion. Internally flawless diamonds are just don't really happen in the pink world as much because they're so small to begin with. So you don't want to start cutting away at a diamond that's already very small. VS2 would be what you walked into a typical jewelry store and you said, I want to buy an engagement ring. They'd probably be selling a VS2 because it's eye clean. Okay. So for us, the clarity is important, but we're looking at color as well. So I put that together. That's about $40,000. I added 1,000 ounces of silver, 20 ounces of gold. You're looking at about 137,000. You now have the conservative protection of wealth on the gold side, the generational wealth on the diamond side, and you have the really explosive growth potential with silver as well. And that was about 137,000. Now, if we wanted to maybe think about the diamond for another day, we could look at 10 ounces of gold, 500 ounces of silver, and you would get 5 1-ounce bars of silver with that, part of the promo for September, and that would come to 87,500. That would be, for me, something perfect for a registered account portfolio. If you've been adding to your registered accounts over the years, time to diversify into precious metals. Think about 10 ounces of gold, 500 ounces of silver. yeah, that to me would be something to definitely start with as well. So you have the diamond option, you have the non-diamond option. Jerry, 20 seconds, 30 seconds.
That right there, Jeremy, is a beautifully well-tailored suit, a perfect hard asset portfolio, one that I would definitely love to tailor for someone. We encourage you to get in touch, learn about the gold and the silver markets, get them in your hands, and test them in the office. Don't take our word for it. If you want to test your precious metals, we have a tester for you, and put us to the test. Give us a call. We'll put up hard asset portfolio like Jeremy just mentioned. And remember, we have the promotion going on. If you buy 1,000 ounces, you're getting 10 ounces of free silver. Why not? This is perfect for yourself and for your family, and definitely in line in what we're talking about. We are going to be seeing a commodities boom, and you'll just be riding this right up.
Yeah, I totally got that wrong, by the way. I meant to say 20 ounces of gold and 500 ounces of silver for 87,000. So you're keeping the gold in there and just limiting a little bit of silver. So talk to us. We'll put a package together for you. The number 18778-SILVER, the website guildhallwealth.com. Thank you so much for everyone listening this week, and can't wait to speak to you next week here on The Real Money Show on 640 Toronto.